Everything looks stable. Markets are reaching historic highs. Unemployment sits near multi-decade lows. Consumer spending reports come in strong quarter after quarter. Every major financial network carries the same message from the same panels of analysts. The fundamentals are solid. This is exactly what it looked like before 1929, before 1987, before 2000, before 2008. Michael Burry does not watch financial news. He reads the filings, he reads the prospectuses, he reads the footnotes buried in documents that no television segment has time to reference. And what Burry has spent years reading has allowed him to identify something that most financial commentary never discusses: a pattern. A specific, historically recurring, mathematically verifiable pattern that appears before every major market crash in modern financial history. Today, we examine that pattern in complete detail. Michael Burry is not a product of Wall Street. He did not come from a trading floor, an investment bank, or a prestigious economics program. Burry trained as a physician. He taught himself investing through years of obsessive self-directed research, reading financial statements, academic papers, and historical market records late into the night while completing his medical residency. His analytical approach was shaped not by institutional consensus, but by raw data and primary documents. By 2005, Burry had identified the exact structural fragility embedded in the American mortgage market that would eventually collapse the global financial system. He did not find it in a research note or a conference presentation. He found it in the prospectuses of mortgage-backed securities, documents that almost no one on Wall Street was bothering to read in their entirety. Burry shorted the housing market when every major bank, every rating agency, and the Federal Reserve itself was publicly stating that no systemic risk existed. By 2008, when the financial crisis arrived with full force, Burry had generated returns of 489% for his investors. That track record is not coincidence. It is the product of a methodology. And at the center of that methodology is pattern recognition applied to primary financial data. To understand what Burry has documented about market crashes, we need to establish what he means by a pattern in this context. Burry is not a technical analyst. He does not rely on moving averages, chart formations, or price momentum signals. When Burry identifies a pattern, he is describing something far more fundamental, a sequence of conditions that accumulate beneath the surface of apparently functioning markets until the weight of structural distortion exceeds the system's capacity to maintain equilibrium. The key insight in Burry's framework is that major crashes are not accidents. They are not unpredictable black swan events that arrive without warning. They are, in Burry's analysis, the logical and mathematically predictable outcome of conditions that were already measurable and present before the crash materialized. The system was already broken before the breaking became visible. What changes is not the underlying fragility. What changes is whether enough participants in the market finally look at what the data has been saying all along. Burry has argued consistently that this is the defining intellectual challenge of modern investing. The crowd always believes the crash is impossible until it is occurring. The analytical minority that identifies the setup in advance is always dismissed, marginalized, and occasionally punished by the market's momentum before being vindicated by the market's collapse. Burry's framework for identifying this setup consists of 5 specific components that he has documented across multiple market cycles. Each component corresponds to a phase in the pattern, and according to Burry's research, these components appear in the same approximate sequence before every major crash, not because of conspiracy or coordination, but because they are all expressions of the same fundamental dynamic, the systematic displacement of valuation discipline by narrative momentum. Burry's central thesis regarding market crashes is precise and uncomfortable. He argues that the financial system contains structural mechanisms that make large crashes not just possible, but inevitable at regular intervals. These mechanisms are not hidden. They are not the product of secret decisions by central bankers or government officials. They are the emergent result of how human beings behave when capital is abundant, narratives are compelling, and institutional incentives reward participation over skepticism. Burry has stated repeatedly that the question is never whether a crash will happen. The question is only when the accumulated distortion will reach the point where the system can no longer absorb it. His framework identifies the 5-phase pattern that precedes the answer to that question. Understanding this pattern does not require access to privileged information. It requires the willingness to look at what is already documented and follow the data to its honest conclusion. The first phase of Burry's pattern is what he identifies as the liquidity expansion phase. Central banks or credit systems make capital extraordinarily cheap and abundant. Interest rates fall to levels that punish holders of safe assets. Borrowing becomes frictionless for institutions, corporations, and eventually retail participants. Capital flows aggressively into risk assets, not because those assets have become fundamentally more valuable, but because the alternative of sitting in cash or low-yield bonds carries a real and compounding cost. Burry has argued that this phase creates the foundational distortion from which everything else in the pattern follows. When money is cheap enough, the discipline of valuation collapses. The investor who applies rigorous analysis to the actual earning power and balance sheet quality of a business finds themselves systematically underperforming the investor who simply buys whatever is already moving upward. Over a sustained period, this punishes the analytical framework that should govern capital allocation and rewards momentum chasing. Burry has described this dynamic as the market temporarily incentivizing recklessness over rigor. The dangerous implication is that as this phase extends, the investors who understand fundamental valuation are gradually replaced at the margin by those who do not. The marginal buyer of an asset in the late stages of the liquidity expansion phase is not asking what the asset is worth. The marginal buyer is asking whether the price is still moving in the right direction. The second component Burry has documented is what he calls narrative capture. As the liquidity expansion continues and prices rise, a dominant explanatory narrative forms. This narrative does not emerge through coordination. It emerges organically from the shared need to justify rising prices with a coherent story. In 1999, the narrative was that traditional valuation metrics were irrelevant in the new economy of the Internet age. In 2006, the narrative was that American home prices had never declined nationwide and therefore structural risk was contained. In 2021, the narrative centered on the Federal Reserve's implicit guarantee that markets would not be permitted to fall meaningfully. Burry has argued that the specific content of the narrative is far less important than its structural role in the pattern. The narrative's function is to suppress the natural skepticism that rising prices and deteriorating value propositions should generate among serious analysts. Once the narrative achieves dominance, questioning it carries professional and social costs. The analyst who raises valuation concerns is not engaging in intellectual debate. The analyst is demonstrating ignorance of the new paradigm. According to Burry, when questioning the dominant narrative becomes professionally dangerous, the market has completed the second phase of the pattern and entered the zone of maximum structural risk. The third element of Burry's pattern is the concentration cascade. As the liquidity and narrative phases extend, capital does not distribute evenly across the opportunity set. It concentrates with accelerating force into the category of asset that has produced the most impressive recent returns. This concentration feeds on itself through a simple mechanical process. More capital flowing into a concentrated set of assets produces better performance for those assets. Better performance attracts more capital. The self-reinforcing cycle continues until the concentration reaches levels that make the eventual reversal systemic in scope. Burry has identified this cascade as one of the most measurable and least discussed aspects of the pre-crash pattern. By the time concentration is visible in broad market data, the structural fragility is already severe. The mechanism of the eventual collapse is embedded in the concentration itself. When the reversal begins, the assets with the most concentrated ownership face the most extreme and disorderly selling pressure. This is what Burry has called the liquidity illusion, the experience of apparent ease of entry into an asset class that will prove catastrophically difficult to exit when everyone reaches for the door simultaneously. The crowded trade never collapses gradually. It collapses fast because the ratio of potential sellers to available buyers at any given price becomes catastrophic the moment confidence in the narrative breaks. The fourth component Burry has identified is institutional consensus lock. As the pattern advances toward its final stages, the financial institutions most structurally positioned to identify and communicate systemic risk become progressively incapable of doing so. This is not, Burry has argued, primarily a failure of analytical competence. It is a failure of incentive alignment. Banks hold balance sheets exposed to the concentrated assets. Analysts at those institutions generate revenue from the business activity surrounding those assets. Research that contradicts the dominant narrative carries the professional cost of appearing out of touch while simultaneously undermining profitable business relationships. The result is not explicit suppression of contrary analysis. The result is structural silence. Burry documented this dynamic in granular detail in his analysis of the 2008 crisis. Rating agencies assigned the highest possible credit ratings to instruments that carried catastrophic structural risk. Investment banks packaged and sold those instruments while their own internal communications acknowledged their fragility. Regulators reviewed data that implied systemic danger and concluded that no systemic risk existed. None of this required conspiracy. It required only that every institution follow its own incentive structure to its natural conclusion. According to Burry, the same mechanism activates before every major crash, producing the same institutional blindness at precisely the moment when institutional clarity is most needed and most urgently absent. The fifth element of Burry's pattern is the volatility compression paradox. In the final phase before a major crash, measured market volatility typically falls. Prices trend smoothly upward. Day-to-day fluctuations become small. The market appears calm, certain, almost serene. Burry has argued that this compression of volatility is one of the most dangerous and counterintuitive signals in the entire pattern. It is not evidence of a healthy market finding equilibrium. It is evidence of a market from which the mechanism of price discovery has been effectively removed. When ownership is concentrated, when the narrative is universally held, when institutional incentives all point in the same direction, the natural friction between buyers and sellers who hold genuinely different views about value disappears. Prices no longer reflect a genuine distribution of information and opinion. They reflect the shared confidence of participants who have, mostly without realizing it, stopped asking whether what they own is actually worth what they are paying. The calm is structural brittleness masquerading as stability. A market that shows no surface volatility while carrying enormous underlying distortion is not stable. According to Burry, it is the most unstable configuration a market can achieve. The absence of visible cracks is not safety. It is the pattern completing its final phase before the fracture becomes impossible to ignore. Applying Burry's 5-phase framework to your own assessment of current market conditions does not require access to the same volume of primary documents that Burry processes. It requires the right questions applied to publicly available data. Burry would begin with the monetary environment. Is capital currently cheap and abundant? Are interest rates at levels that punish holding safe assets and push investors toward risk regardless of valuation? If yes, the first phase is active. Then examine the narrative environment. Is there a dominant story about why current valuations are justified? A story compelling enough that questioning it generates hostility rather than intellectual engagement. If yes, the second phase is active. Then, look at concentration. Are the assets with the best recent performance also the assets with the highest capital inflows? Are they becoming a larger and larger share of benchmark indices? If yes, the third phase is active. Then assess institutional behavior. Are the largest and most credible financial institutions producing research that raises serious structural concerns, or is the output from those institutions predominantly confirming and extending the existing narrative? If yes, the fourth phase is active. Finally, examine volatility. Is measured volatility historically low relative to the structural tensions that the previous questions have identified? If yes, all 5 phases of Burry's pattern are active simultaneously. What Burry's framework does not give you is a date. It gives you a diagnostic map of accumulated structural risk. It tells you how far the pattern has progressed and how little distance remains between the current state of the market and the point where the distortion exceeds the system's capacity to sustain it. What you do with that diagnostic is a decision only you can make. But the question of whether the pattern is present is the question that matters most, and it is the question that almost no one is asking. Today, we have examined Michael Burry's framework for recognizing the 5-phase pattern that precedes major market crashes. The liquidity expansion that displaces valuation discipline, the narrative capture that suppresses natural skepticism, the concentration cascade that builds structural fragility into asset ownership, the institutional consensus lock that silences the voices best positioned to warn, and the volatility compression that signals maximum brittleness beneath an apparently calm surface. Burry's record demonstrates that identifying this pattern in advance is not a theoretical exercise. It is a practical and necessary act of analytical discipline for any investor who intends to protect capital across a full market cycle. The pattern does not announce itself. It completes quietly, in plain sight, in the data that is already available to anyone willing to read it carefully. The market before a major crash does not look dangerous. It looks stable, justified, and rational. That appearance, Burry's work shows us, is not reassurance. It is the final element of the pattern itself. Thank you for watching.